Good morning, traders and investors. Today's Friday the 10th of March. My name is Roger Scott, and I'm still the senior strategist of Wealth Press. Now, as you can see here, the Nasdaq is up about 20 ticks. The Dow's down 50 points. But I want to show you how full of it Wall Street is, okay? So I want to show you something really, really interesting, okay? And this all goes to algos. You know, Wall Street can't just say algos decided to take the financials down. They have to make a story behind it. So I want to show you something interesting. Now, we're going to go through this today. But basically, what Wall Street is saying is that the stock market erased early gains by an unexpected rise in jobless claims, okay, and moved sharply lower as the financial sector dragged on. That's the story. Everybody's sticking to that story. Here's the problem with that story, okay? Two problems. First of all, the report came out 8:30. It came out an hour before the market opened. So the market had plenty of time to get into a position to go down. I can assure you this was not the big issue, okay? This was not the problem. This was not the reason why. An hour, all of a sudden the market decided to go lower way into the open, but this report comes out an hour before the open and the market opens up and rallies over 100 points. I don't buy it. That's number one. Number two, the report wasn't bad. The report was 211,000 versus 205,000. Look at the new moving average, 193,000, 197,000. This report has been the most stable report for the last God knows how long. All right. So I find it really, really, really almost laughable to think that this report is what did it. What did it is two things. Negative news about JP Morgan and Jamie Dimon and Jeffrey Epstein. That's what triggered this bank sell-off. Okay. And number two, still the market reeling from the effect of Mr. Powell. It had nothing to do with his jobless claims. Algos took this market down. They triggered financials yesterday that were more than anything you could ever imagine. I was even telling everyone this week, yesterday, how this report is going to come out neutral, maybe a little higher, maybe a little lower. But honestly, we've seen this report go up to 225, 190, and it doesn't impact the market because it's been really, really steady. I mean, look, the 4-week moving average is 193. Now it's at 197. If you call that a major uptick, I mean, 4,000 jobs in a 4-week period, that's randomness, okay? That's just total randomness. So I love how Wall Street brings in their theories and ideas and likes to blame things after the fact. But the truth of the matter is, the market's been in a wait-and-see mode for a while. And after this Fed statement, they decided to take it down. Now, typically, I would say we got to be careful from down below. But I smell an algo rat. I smell algos taking this down. So I want to show you why I don't think this market is going to go down much further or crash and burn, and why I think it's going to remain here. There's a couple of reasons for it. If you look at the number of stocks in the S&P above the 50-day moving average, look at where we're at right now. We're almost at the bottom. So maybe we go down a little bit more, but look at this. In the last 20 years, we've been below this level how many times? Once, twice, 3 times, 4 times, 5 times, 6 times, 8, 9 times in the last 20 years. So this doesn't look to me, again, if we were up here, if we were up here or up here right now on momentum levels, and I saw this, I would be really, really scared. But if you're looking at it, and if you're looking at it as a whole, we're already down here. And also while we're at it, just so you know, and yes, they're all red as I predicted they would be, but look at how oversold everything is. Utilities, look at where utilities are. They're at the bottom, literally at the bottom. Look at, one second, let me show you something else. Let's look at financials right now. Oh boy, look at where they're at. I mean, how many times have you seen financials go below this level where we're at right now? 1, 2, 3, 4, 5, 6, 7 times in the last 10 years or 20 years. Oh, this goes back to 15. So in the last 7 years, we've been below the current level 1, 2, 3, 4, 5, 6 times. Don't think financials are going lower. So I'm not seeing it. I'm not seeing it at all. And in the QQQ, if you look at the QQQ, we're not there yet, but looks like we can go a little bit more into QQQ. But as far as the broad market, as far as the S&P 500, it just doesn't look like we have all that much to go. And again, I'm showing you the levels where we're at right now. Just don't, maybe a little hair, maybe a little more down and up. But A, I don't think it was caused by the jobless claims report. And B, the algos had just about everything to do with it. Keep your eye on the level. We're at the 200-day moving average, and we typically bounce from there. And notice today's low is lower than the previous lows, which means there's a lot of stops that got stopped out here. So that could be a major, major issue. But as far as momentum levels, I'm just not seeing it. I'm not seeing anything crazy at this point. I'm basically seeing more chop shop. There's no real fundamental reason for the market to drop right now. What the Fed said has already been priced in, and I'll get into that in a minute. The bond market is actually reacting positively. It's not reacting negatively. It's going up. So I don't think that this market is set to go lower. Also, the expectation of the interest rate hike went from 70-something% of 0.5. Now it's closer to 50%. So this economy getting worse, or the banks taking us down, was not a broad market move. It was a very concentrated move in financials that took us down really, really hard. And right now, I think the market wants to pop back up, at least for the time being. This is too much too fast. This isn't a sign of stability right here. And this is Fed right here. This is Fed and banks. This is not a broad market major sell-off. So just so you know, I think we're going to be bouncing back. Maybe we're not going to be bouncing back and making new highs anytime soon, but I don't think this has that much more follow-through, simply because momentum levels are just not overdone right now. So I think this is just a classic shakeout where the market wanted to take us slower. Also, if you look at small caps, They've barely been moved by this. Look at Kathy. Barely moved by this. So I'm not seeing what a lot of investors and traders are seeing as a major broad market sell-off. That's number one. So let's talk a little bit about what the narrative is. And I've already told you my position where I stand. So U.S. benchmarks closed lower on Thursday amid aggressive slide in financial stocks. Well, there was a slide in other stocks too. It wasn't just financials. While investors looked ahead to key U.S. non-farm payroll data, that's going to be released in about 54 minutes. In Thursday's session, all three major U.S. indexes erased gains by an unexpected rise in jobless claims. I already showed you. It wasn't all that big. It was 4,000. I mean, really, it's not a 500-point move into Dow worth. And moved sharply lower as the financial sector dragged the broader market into negative territory, with benchmark dropping, S&P dropping to a 1.5-month low, and the blue chips slumping to a 4-month low. But the blue chips have been it's just stagnant. So it didn't take much to bring them into a 4-month low. SVB Financial closed 60% lower. Silvergate Capital plunged 42%. Big sell-off in Bank of America, Wells Fargo, Chase. On the positive side, GE did well, which is really, really good. So economic data on Thursday showed weekly initial jobless claims rose to a 2.25-month high. 2.25-month high, folks. 2.25-month high. Really? That's the best they could do? 211,000. Ooh. Weaker than expected of 195,000. I mean, come on. Pointing to signs of a crack in the strong labor market. That's just nonsense. Also, U.S. continued jobless claims rose to a 2.5-month high of 1.718. That's 1,718,000 to 1.659. So, I mean, really, the numbers were not all that high. Now, U.S. futures have now pricing in almost 50% chance of a 25 basis point rate hike and only a 54% basis point hike of 50 basis point hike. So even the Fed, even the bond market is telling us that we may not be going down 0.50. And if it continues that way, if this gets to 60, 70%, then that'll start being priced into the market. But we got to watch this really closely because this has a major impact. And remember, this is based on the price of the bond. But we went from like 70-something% to 54% overnight. Today, everybody's focusing on the non-farm payroll. They're looking at the number to come in at 205,000, which is not a high number, compared to previous value of 517,000. Also, investors will focus on the U.S. non-farm payroll, which stood at 443,000 in January. Now they're looking at 210. I don't know why it says 517. It was 443. Europe is down. Also, banking stocks head for the biggest one-day decline in 9 months, while investors are also turning off ahead of crucial non-farm payroll data. That'll be interesting. China closed lower. Also, financial stocks led the way lower, and lack of a new catalyst for the ongoing National People's Congress. They don't really have a catalyst, and their economy is not picking up as well. Japan closed lower for the first time in a while, even while they're maintaining their ultra low rates and kind of keeping their head in the sand. Now, in terms of movers, DocuSign, big mover. Oracle, big mover. Gap, big mover. So there's a lot of movers. Keep your eye. In terms of earnings, we're pretty much done and out of the way. Now, sectors, I want to go into a little bit of sectors. Industrial. I wouldn't, again, not a big fan of technology at these levels. I know it's holding on, but communication services is not. Consumer discretionary is not. And again, the fact that they're so far away from each other makes me sniff a rat, all right? I do like utilities right now. I like consumer staples, which are actually starting to come up. I think these sectors are going to start coming up, and I don't think there's a major catalyst, and I don't think the market is really ready to go lower yet, and I'm not seeing it at this point. Again, as I mentioned to you, momentum levels on the S&P are pretty low right now, so I'm not expecting a major crash or burn or anything like that, and I simply think that the algos use their opportunities to shake us out right here. Now, if we continue moving parabolically lower, first of all, I think we need a catalyst, like a really, really bad jobs report today. But I think overall, I think this market is going to kind of stick to this ground, maybe start heading a little bit lower, but I'm not seeing any type of parabolic move. And usually after a move like this, look, a big move like this, it starts to rebound, especially with the fact that the bond market is not really reacting. And that's really, really important. The bond market and Kathy, our friend Kathy, are not really reporting. And remember, when markets really go down, the smaller stocks are the ones that are supposed to crash and burn. Now, we did see that on the Russell 2000. There's a lot of financial stocks. But again, we're right at the 200-day moving average. And my experience tells me that we usually bounce off the 200-day moving average, even if the market is in a selling pressure mode, although I'm not really seeing it at all. I'm seeing the market actually cooling off just a bit and momentum levels getting a little bit better, but I'm not seeing any major selling pressure. We've got a lot of stocks already way below the 50-day moving average. The 200-day moving average has a lot to go, but this is more of a stability indicator, and this is more of a swing trading indicator, and you could see everything is red except industrial. I told you that industrial stocks were going to be the best stocks and they were going to hold on, and I actually gave you a pick yesterday for industrial stocks. Now, let's look and see which stocks are leading right now. It's kind of important. I want to see what's leading right now. Let's see here. First Solar's looking good. Steel Dynamics isn't looking all that bad. Win isn't looking all that bad. Now, the fact that Win is rallying right now, that's a very strong sign that we're going through a recovery. United Rentals is still up there. Again, these parabolic moves, not so sure about them. Lamb Weston is doing well. But you can see here, the market is fairly broad right now. In terms of stocks making 24-week highs, there's some. General Electric, ANET, MaxN. This one looks beautiful. BSAC, Banco Santiago. You could see no correlation, and it's a bank. No correlation to the U.S. stock market. And let's just go back one more day. There's a couple of juicy ones there. NVIDIA still looking beautiful. United Airlines still looking beautiful. There may be some bargains out there. Bowl is looking good. As I mentioned, ANET is looking good. Dick's Sports never gives up. Still looking really good, but a little parabolic in my opinion. SMCI, Super Microcomputer, is looking pretty good. Notice a lot of these stocks are not large cap stocks. PRG, Aaron's is looking good. It's an interesting stock right here. But you've got some interesting stocks, but not a lot of large cap making 52-week highs. For the foreseeable future, you may want to lower your market cap and start looking at mid caps. Mid caps, let's take a look at mid cap scan so we can see if there's any good players out there. Well, First Solar's looking good. Cody, Tex. Yeah, I don't think these stocks are going to kill their uptrend with this. I really don't. I think it's more of like a sell-off like this right here. So Lattice Semiconductor, look at this stock. I've been talking this stock up now for months. This has a wide spread, but what a stock. Again, Dick's, PRG, 5 below, still up there. It's kind of a little wonky, but still up there. Tri-Point Homes is looking pretty good. Tempur-Pedic. The bottom line is Builders First Resources. There's a lot of mid-caps. Stay away from the large caps for the time being. Now, today, here's the thing. If we don't get a bounce today, and if we keep going lower, I will be concerned, especially if there's no major catalyst and if the economic data coming out is good. So far, what I believe is this is just algos using an opportunity as and disguising it as a bad jobless claims to take the market down. Also, notice the range, 160,000 to 324. I would rather look at the unemployment rate, and it looks pretty tight. Hoping it's going to be 3.4, 3.5%, and the market will gently come up. Also, there's a good chance on Fridays where the markets open lower and then do a little U-turn as the day continues. So it's probably best to start checking and seeing what's what towards 10 a.m. Eastern time, 11 a.m. Let the market shake its out. There's still a lot of probably a lot of selling pressure from last night. Let's see if it tightens up. So again, I think what we've seen is just classic algo moves. Momentum levels are really, really low. I mean, I showed you financial. Look at this. I mean, look at this yourself. Look at where we're at, where financial levels are. We're at the bottom here. So I'm just not seeing a major momentum, directional momentum. I'm seeing more of a maybe another little shakeout, a baby shakeout. And look at energies, by the way. Energies are looking really good right now. Look at that. They look like they don't want to go further down. So again, maybe a little bit more, maybe a hair lower, but honestly, I'm just not seeing a major sell-off. I'm seeing more choppiness right now in light of the momentum levels. If the momentum levels were this high, that's one thing. Also, and I know a lot of people say the VIX is broken. I don't believe the VIX is broken. I just don't think we have a major catalyst for upside right now. All right, folks, Warren Buffett, he just bought 6 million shares of this energy play. And oh boy. And when the Oracle of Omaha makes a move, it speaks volume. With the energy crisis in full swing, and yes, we're still in an energy crisis, even billionaires are hedging their money. That's why Jeff Zananeri is calling an emergency meeting. He's going live at 10 a.m. Eastern today to reveal not one, but 2 tickers for potential energy plays. Follow the link. Don't miss out. Jeff is going to be live at 10 a.m. You don't want to miss out on this. It's going to be a great session. If you don't know where the link is, go to the YouTube Wealth Press channel and find it there. There's a Telegram subscription button, which we use to post alerts. And when these videos come out, my cat pictures are there. Like us, subscribe to us, and comment. I want to hear from you. And I hope you guys enjoying these videos, and I will talk to you next week. Bye.